And on today's show, misspent life insurance dollars, part 5 of this week's series, the top business succession blueprints, with the architect of Blueprints for Tomorrow, Nate Sachs. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. And InSmart. Let's get down to business. Well, welcome to day 5.
Thank you, Steve.
Well, I'm talking about this whole week. I feel like, again, been on the psychological couch of business succession planning. Not doing any math. We're not talking about product. We're talking about how to actually talk to employers, CEOs of their business, and actually get the sale, because we're doing it a completely different way. When we talk about differentiation in yesterday's show, and if you missed yesterday's show, I think this is a major show of the series, because it really talks about distinctives, and everybody's looking for things that are distinctive. I'm telling you, your approach to business succession planning is so outside the 9 dots, Nate. I'm telling you, I've never seen anything like it.
Thank you.
I want to talk today, though, because you make a big deal about this. You see this happen all the time. You have over 2,000 business owners as clients. You work with over 500 advisors. You've been at a top of the table producer for decades. Tell me, why is this happening, and why is this such a big part of our series?
First of all, I've paid now, as of Friday, 46 death claims of business owners.
Wow.
So I see exactly how devastating death can be for a business owner. Not just for them, but for their family, their business, and the families that depend upon their business.
When you think about delivering your death claim when you were a young man, and now way into your career, has your approach changed a little bit since you've delivered a claim?
You know, it's that same emotional, thank God I'm here. It's a calling. I really got rewarded. I had a widow call me from Southern California who I just delivered over $2 million to back in October. She said, I've got to tell you something. When my husband brought you the door, because the husband and I worked together for maybe 3 or 4 months, he said, bring the insurance proposal to her. She said, I wanted you out. I wanted nothing to do with you. You were forcing me to talk about my husband in terms of death. I hated you. She said, I actually hated you.
Wow.
Thank you for being persevering enough to stay and make this thing happen. He died in September. He dropped dead very unexpectedly of a heart attack, the prime of his life. And that $2 million is going to take care of her forever. So when I get a phone call like that, thank you for staying. Thank you for persevering. Makes up for...
It is really something. Until you go through and file a death claim. I have so many young millennials that are in our business who have yet to experience a death claim.
I was told when I first came to the business, until you actually pay your first death claim, you're not really in the business.
I totally agree with that. Well, let's walk through some of these things. We want to prevent the misspending of life insurance dollars, because life insurance dollars are very critical to some of the areas that we use in this business succession plan. So talk about that, and let's walk through it.
I am very, very confident that most business owners are misspending their life insurance dollars. And it's wordsmith. When I even talk to you as a business owner about misspent life insurance dollars, there's a very good chance you're overinsured. The minute I say that, your ears perk up. You've waited your entire life for an advisor to walk in and admit you might be overinsured. Maybe it's the wrong company, the wrong product. Maybe you're being dinged for a problem that's no longer dingable. Maybe it's the wrong beneficiary. Maybe it's the wrong ownership. No one's looked at it recently. We're going to have a dialogue.
When you have, now that sounds like you just distilled down a policy review.
That's exactly what I've done.
Okay, but now in your
But I talked about it in their terms.
Right, and this is what I want to get back to you're using semantics in a different way, Nick. Yeah, your words. I'm on this show. You could say we're on the anvil of wordsmithing. You're dinking through and really teaching us how to talk about this. When I'm talking about the structure of a policy and a underwriting issue, which you alluded to, how much of this, when you do the review, you say, Steve, I can't believe this is an underwriting. I can fix that. This is a policy structure. I can fix that. It's a beneficiary issue. The ownership's wrong. How many of the times when you walk through this, you've had 2,000 business owners, how many times do you face this?
Whenever I've done, I'd say 3/4 the time, if not more, I can correct something very quickly. Something as simple as, I didn't know you smoked. Well, I don't smoke. Haven't smoked in 10 years. You're still being charged smoker rates. Never talked to my agent, and he never talked to you. So it's not necessarily monumental changes. It can be. Often we do a 1035 exchange and 3 or 4 times more coverage for the same amount of money. But it could be something very simple. As a beneficiary that's no longer alive, the wrong ownership for tax purposes, being dinged for smoking a cigar, which you no longer smoke, things that no one's looked at recently.
I noticed in your line here, because you've been selling quality blue chip policies for a long time. You have certain demarcations of ratings that you use for company, but the evaluation of a financial security of the insurance company is now that's on your radar as well.
Steve, without mentioning, which we obviously would not do, there's a couple AA+ companies as recently as 3 years ago that are now downgraded not from A plus, not from AA to A, but not from AA plus to A plus, from AA to A minus or B plus. Their condex has gone from the 90s to low 70s or even high 60s. That's frightening. So even though I've always sold tremendously strong companies, even some of my own clients I'm moving right now because the companies in the last 12, 24, 36 months have had such a changeover. And let me say one thing without being negative. We're facing as an industry for the first time venture capitalists buying insurance companies. Whole philosophy can change. What could be a great insurance company today might not be so great performing on paper in the future because the venture capitalists want to maximize the profit in the company, not necessarily on the policy.
We'll be right back right after the break. We're going to talk more on misspent life insurance dollars. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. Of course, we're with Nate Sachs. Nate, we're talking about misspent life insurance dollars. The only other time I've had the word misspent has always been my misspent youth. Now we're talking about misspent life insurance.
Still misspent.
Yeah, still misspent. Talk a little bit about trust owner life insurance, owned life insurance, because everybody kind of think Totally not really popular anymore, or nobody's dealing with it anymore.
When I say totally, I don't mean the Harris Banks.
Sure.
I don't mean the large trust companies. They're great. They've got people that watch this. I'm my brother-in-law's trustee, and it's trust-owned policy. I haven't looked at it in years. I pay the check when he tells me to. I don't even know what a crummy letter is. I can't even spell crummy. When we look at those kind of policies, we're finding 5 to 10% are in danger of lapsing in less than 3 years, 20% in 7, and 80% of every one of the policies in this study, which were 550 policies looked at, 80% were under restructuring or replacement. And the non-professional trustee world, 71% had not reviewed the policy in the last 5 years, and 95% had no procedure how to do so whatsoever.
What's the liability to the trustee on this?
Huge. I was asked recently, 3 years ago, to be an expert witness. Listen to this. Very strong company, variable life policy. Again, 12, 13, 14 years ago, projecting 12%, never hit 12%. The two beneficiaries are the daughter of the insured. They're now being told by the insurance company, you have to come up with basically 4 times the premium of this policy dies. They turn around to the trustee and said, what's going on here? We don't have 4 times the premium. Dad's now got Parkinson's. We can't move the policy. You're the trustee. You've been getting these notices every year. You should have been asking for updated numbers. The trustee was their aunt, who was also a CPA. The court ruled against her. Said you had a fiduciary responsibility. The girls are right. And they won the lawsuit, almost $1 million. So
this is a very important issue. Let's talk about this. I want to go back to your front end. 10% of policies are lapsing in 3 years. Well, okay, that's a small number, but still a dangerous number.
But let's combine them. 30% are lapsing in the first 7.
Well, to me, that would be unacceptable to know that I have a permanent need with a time where my contract is going to lapse. That to me is scandalous.
Basically, you better understand you were going to outlive your insurance policy. And that's a frightening place to be.
I think when you think about life expectancy right now, I mean, Nate, we're talking about serious. I mean, we may be adding 5 to even a decade on top of the old 2001 CSO.
Totally.
I mean, this is a huge. Now, talk about this warranted restructure. When you talk about there's warranted restructuring on a lot of contracts, give me an
80%.
example.
Well, here it is. I broke it down. 1 out of 5, there's actually premium savings. 1 out of 5, we can say there's an increase in death benefit. And the average policy we could extend out for at least 5 more years longer than the current one. So either more death benefit for the same money or less death benefit for the same money, or if nothing else, get a longer death benefit than you currently have.
Well, I like the extension issue because that's what we've been doing on a lot of repair work or reconstruction. Has been trying to extend the length of it because I'm after looking at the physical and looking at the mortality cost that the company's charging, I'm suspicious we're going to outlive this.
Well, see, the world changed. You and I sold a lot of cash value life insurance when we came in the business. Savings, retirement. Now I'm 65, 66. I've got plenty of other assets for retirement. I've had heart disease or cancer. The death benefits are very, very important to me. And you're telling me the death benefit is nowhere near it should be because there's a loaded cash value policy of cash that I don't need. That's what we're seeing.
When you look at the weak structure and you're using this, I know that you go through, you've looked at so many of these policies, and this study was 550.
Right.
When in your own practice, when you go through this, what does it take for an advisor to do a really good due diligence walkthrough on a policy? Is it going to take how many
It's very
hours?
simple.
What does he
No,
know?
it's all we have to do is get the permission from the owner to please let us acquire the insurance records, some basic information, 3 or 4 questions from the insured to kind of get an idea of the life expectancy. Then we turn it over to Ash in Fort Wayne, which is a think tank of amazing people that 30 days later will crank this whole thing out for me and do it in a very professional way, where there's all sorts of alternatives. They're not commission oriented, so they're not biased. They're not looking for a sale. They're looking to do what's best for the client, for the policyholder.
When I go ahead and do a kind of a review like you've suggested, and you come back with that, how much of that review sometimes is very much just simply medical? We can get a better underwriting decision.
It is. And what I'm pushing for right now, and I'll tell this to the whole world, is getting people to move from current assumption to guaranteed death benefit. Because as you know, that window is getting shorter and shorter all the time. Every quarter, another major carrier sends me an email or a letter saying we're no longer in the guaranteed death benefit business. I believe in a couple of 3 or 4 years, you'll not be able to find guaranteed death benefit policies. So forget the cash value. But if you think you're going to live to 95, get a policy that says it will pay if you live to 95.
Yeah,
Guaranteed.
And that's a important thing to bring up. Before we close out this today and the week, give me a summary statement on why your procedure, not only successful to you, but how you've made it successful for almost 500 other advisors.
It's wordsmith. It's how I say it. I'm the anti-advisor. Instead of coming in and beating you up, you got the wrong policies, you got the wrong product, you don't have enough insurance. That's old school. New school is talk to them in terms they understand. I think you're misspending your life insurance dollars. I think there's a good chance you're overinsured. The minute you say that, you've engaged them. You've got to get them engaged. You've got to get them disturbed first before they want to listen to what you have to say.
Well, that's all the time we have for the show. Remember, before moving forward with any of the ideas you hear here, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can go back and see any of our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you next week.